What's up, team? Chuck with Traders War Room, and I'm back at you with another training video. Okay, today we're going to talk about option spreads, and I want to be very clear that this is more of an advanced strategy with options, but it's great information. And someone put the request for training that they wanted to go over this, so man, I made this video so that we can go over it real quick. The basics. And listen, I can't cover everything with this. You're going to have to do some DD, but I'm going to give you guys the bread and butter on option spreads. Okay, so without further ado, let's get it. Traders War Room wants to remind the viewer that all the content on this channel is for entertainment and education purposes only. You're responsible for every decision you make. Have fun, be cautious, but always go to war. So first things first, what are option spreads, okay? Listen, option spreads are a way to diversify strategy when trading stocks and options, okay? When done correctly, they can hedge a lot of risk and improve profitability. But they're more complex than straight puts and calls, which is why you have to kind of know what you're doing beforehand. And I always suggest trying it out before you go in heavy and deep on something simple with like one that you're not really intending to make a lot of money on, and you're just kind of getting your feet wet so you understand the process. So how are spreads done? All right, basically investors buy and sell options on the same underlying stock. All right, let's take Tesla for example, okay? Investors buy and sell options, both calls and puts, at different strike prices, okay? They can also do something called calendar spreads where they're buying and selling the same strike price but at different expiration dates. We'll talk a little bit more about that later. This can assist the investor in reducing risk, lowering margin maintenance, and reducing the cost of entrance. So example with Tesla, right? $900 something a share, all right? The contracts for options are very high up there. Sometimes if you're getting close to at the money, you're talking about, $800, $900, maybe $1,000 for a particular option play, right? Well, if you do spreads, you can reduce your overall cost by getting some skin in the game, but you're also going to be limiting your overall potential of what you can gain. So we'll cover that here in just a little bit. So when we're talking about a spread, right, we're talking about a spread referring to the difference between strike price and expiration price of two or more options on a particular stock. The different contracts are known as legs of the spread. Three main categories for spreads are vertical spreads, horizontal spreads, and diagonal spreads. All right, so let's talk about the different type of spreads, right? Vertical spread. Basically, we're buying and selling calls or puts with different strikes but the same expiration date. Common examples of this are bull or bear call put spreads. Horizontal spread. Buying or selling calls or puts with different expiration dates but the same strike. These are known as calendar spreads. And diagonal spread. Buy and sell calls and puts with different strikes and different expiration dates. We are going to focus on vertical spreads as this is the most common when you get into the spreads, and I'll cover the horizontal and diagonal ones in later videos, but today's focus is vertical spreads. All right, when we're talking about vertical spreads, let's talk about the most common ones that we get. Bull call spread and bear call spread. So first, bull call spread, also known as debit call spread. Things to know about this one: it's betting that the stock will increase, two options creating a range high and low, and it limits loss but also puts a cap on gain. The same thing with the bear call spread, known as the credit call spread, betting that the stock will decrease, two options creating that range again high and low, but once again limited risk but limit reward as well. So now listen, I'm going to give you an example. Love or hate it, man, Robinhood has the most simplified version of option trading that you can get, okay? And they even have little dummy-proof little signs and little pictures to do it. So right here, we have a bull call spread or a debit call spread. And I'm going to leave this here. I'm going to let you kind of see my arrows where I'm doing it. But we notice that I'm using Tesla as an example. Check those two arrows pointing to the left up there. Those are giving you your ranges, okay? Your buy, option and your sell option, all right? That yellow arrow pointing to the right, that's the cost that it's going to cost us. Now it's debit, so it's costing us. When anytime you see a debit, it costs us to get into this one, okay? Now, look at the picture there. this is a bull because obviously we want the stock to go up. So you see the green arrow there, we're making money, okay? You see the red arrow there, we're not making money, we're losing money. So we want this particular stock to go up to that point so that we can make our money on this particular trade. That's important to know about a bull call spread. We're betting that the stock is going up to make money, but we're also limited on the amount of money that we can make. Unlike if we got a regular option call or we got into the stock, theoretically, the amount you can gain is limitless. However, with these spreads, we are capped at a certain potential. However, we're also capped at our maximum loss, so we can't lose it all on this particular play as well. So we know our maximum price that we're going to get. We also know our minimum price we'll lose if it goes bad. Now, here's a bear call spread or a credit call spread. Now, notice the same levels there. You see the yellow arrows pointing to the left. Those are telling you the trade you're getting in. You're buying or selling whatever particular strike you're getting into. And also, we got the amount that we're going to be credited. What that means we're going to be given when we get into this thing. Now, I need to let you guys know this is bearish, okay? So we want this particular stock to go down. If it goes down into the green, where you see the green arrow, we start making money. If it goes into the red, we start losing money. Again, our maximum gain is capped and our maximum loss is capped because we know those particular areas that we have. So that's how we minimize risk from either losing money, but unfortunately it's limited reward because we can only make a certain amount back. Now I want you to pay attention to this. This is a bull put spread or a credit put spread, okay? Remember we were doing call spreads, but this is a bull put spread. Basically, you can even bet on a stock going up or making an upward movement using puts to your advantage, okay? So notice there, we're looking at the buy contract, the sell contract, and we're wanting this stock to go up in order to make our money. Conversely, if you have a bull one, you got a bear one, and this is a bear put spread or a debit put spread, okay? So you want the price to go down, we're using puts for it. Again, check out the arrows. That's your ins and your outs, what you're buying and you're selling, and how much you got to come with it. So, and we're actually going to go over how to do the process using Robinhood of getting into these multiple contract type of trades. So, how do we do a particular spread play, right? Well, let's take Tesla. Underlying stock, $909.20. Let's use this because it's a popular stock, it's trendy, and it's also kind of expensive. So not your everyday retail investor can just buy into this with their particular funds that they have available. Now, when you're using Robinhood, all you got to do is go to the stock and hit buy and go to trade options. Now, I wanted to highlight this screen because, of course, we're going to go to October 29th, but I wanted to give you guys these resources. If you've never used these resources that Robinhood gives you, man, they make it Barney style, okay? You can, if you think the stock's going up or down or neutral or sideways, whatever, they'll give you guys these references so that you can learn more about that particular trade option that you want to do. And since we're talking about call debit spreads and put credit spreads, things of that nature, they have those options right here. So in this example, our first option that we're going to do is we're going to buy the 910 call. Our second option that we're going to do is we're going to sell the 905 call. And I want you to look at that arrow that tells us we got two options selected at the bottom, and we can hit that little arrow and see what we got as far as a kind of a roll up and a little picture graph of what we have. And so when you pull it up, we get this, okay? This is our call credit spread. Now this is the amount, $2.80. That is the credit that we're gonna get from this. Now this is a bear type of spread because we make money as long as it goes past and below $907.80. And our max profit again is capped at $280 for this particular contract. Now we're going to lose money if we stay where we're at currently at 909.20 or gain any more money in the underlying stock. So we're betting on this particular trade that the stock kind of did a good run up and that it has a little pullback, and we're going to try to make our money on the pullback, and hopefully it dips below 907 and 80, so we'll start making some money. Now, I wanted to also show you that we can do this with puts as well, okay? So now, as you see, I bought the 910 put and I sold the 905 put, and we're going to see what type of spread that we have. So we have what is called a put debit spread, very similar to the call debit spread, where this is the amount of money that it's going to cost us for this contract, $2.25 per contract. And we're betting on the put debit spread. We're betting that the stock is going to go down below 907.75. That's how we make our money. If it stays where it's at or the stock goes up before the expiration of this, we're going to lose our initial investment of $225. So max profit on this is $275, and our max loss on this is $225. So now I showed you guys the type of different spreads that you can do with these vertical spreads, right? I kind of walked you through it. I used Robinhood because, man, there's not another platform out there that is as simple as Robinhood is. Now, once you get more advanced, you'll probably want to start doing your option trades on a more established broker. But for right now, Robinhood is good enough to get us through the basics and learn how options play and how options trade. Now, some pros and cons of vertical spreads, right? Limited risk of net loss. That's a pro, okay? So you know how much you're going to lose. It's not a maximum loss gain out there, and there's not a maximum gain. So you know what you can make, you know what you can lose, okay? That is also a con because you're capped at the level that you can possibly make, okay? So it's a pro and a con on both of those. Theta doesn't eat away at the contract because you're buying a contract and also selling a contract. So you don't have to worry about theta really eating into your contract. And this is especially helpful if you're going out further on your particular spreads. If the stock shoots up or down, depending on the trade, you lose any potential gains past limit of contracts. So that's a con because, again, we know what we're going to make if it goes to a certain level, and we know what we're going to lose. But like if you had a regular call option or a put option, if the stock jumped up on our call option, just huge, theoretically, your potential you can make is unlimited, right? Same thing with the put. However, on these spreads, we know what we're making and we know what we're losing. Another pro that I really like, and this is what really is the attractive part of this, is that it's a cheap way of controlling expensive stocks rather than buying in shares or single contracts. Okay, that's a pro. So you can get your feet wet and you can trade in with, Tesla and Amazon and Google and things of this nature, and you don't have to shell out, $1,000, $2,000, $3,000. You can get your skin in the game with relatively smaller positions and kind of learn your craft, learn your trade, and get your strategies and make some decent money here and there on particular trades of the bigger blue chip type of stocks. All right, team, and hey, that's the video. I hope you found something useful with this. Again, I can't cover everything with these particular videos, so you got to do your DD, and I promise you that we will talk about the horizontal and diagonal spreads later on in different videos. But because vertical spreads are usually the first ones that people get into when they're starting to think about advanced options, I wanted to cover those because those, especially the call ones, those are the ones that most of us are going to get in and get our feet wet before we start to really dive deep into understanding advanced option trading. So I want you guys to remember, at Traders War Room, we look at the stock market like it's a war zone. Stocks and sectors, those are our battles. We do it together, man, as a team. I want you to join us on the journey. Check the description out. Lots of tools and tidbits to make you a more successful trader are there. And I want to see you guys trading with me next week and further on. Now, all I got to say is if you're ready, follow me and let's go to war.